Are you new to investing and have a small sum of cash saved up but don't know where to start? Are you looking for a relatively safe and diversified group of stocks to start off your portfolio? This video is meant for beginners looking to invest and need a starting point for where to put their first $1,000. This video is pretty similar to my top 5 ETFs for 2021. That video was pretty conservative and geographically diversified. This video is focused more on Canada and focused more on dividends, but that doesn't mean you're not getting some capital appreciation as well. I'm thinking of turning this into a 3-part series of where I show you where to invest your first $1,000, $5,000, and $10,000. With the $1,000, you don't have much wiggle room to take some risks, but with $5,000, you might be able to throw a couple hundred into some riskier speculative purchases. With $10,000, you might be able to throw in $1,000 or $2,000 into some growth stocks or some speculative purchases as well. Anything more than $20,000, I feel like you already have a good starting point. You already know what you're doing and you don't need my advice. Please thumbs up the video and subscribe to the channel. You'll learn more about stocks, you'll learn more about personal finance and investing, and you also get to see some options trading if you're interested. My first recommendation is you invest 20% or $200 into zeb.to. This is BMO's equal weight bank ETF. This fund invests in Canada's top 6 banks. So there are only 6 holdings, so you can technically recreate this portfolio yourself if you'd like. The fund owns BMO, Bank of Nova Scotia, TD Bank, RBC, CIBC, and National Bank. I love looking at the fact sheet. It shows 100% invested in the financial sector and 100% in Canada. So there's not much diversification here, but that's where the other ETFs come into play. I love how BMO is conveniently the top holding as well. I chose this ETF for a few reasons. I like the monthly dividends. I'm very bullish on the Canadian banks. I believe they're stable and they have great balance sheets. The fund is currently trading at $29.11 and pays a 3.26% dividend yield, paid monthly. Looking at the annual performance, not including dividends, the fund has returned 9.6%. If we use the S&P 500 as a benchmark for the market, it has returned 9.8% with dividends reinvested. So based on these past 11 years, you'll be doing pretty well if the trend continues. The management expense ratio is 0.61%. I'm not sure why it's so high. What management do you really have to do? It's only 6 underlying stocks. Maybe it's the administrative work of paying monthly dividends? I'm not sure. If you want to skip the management expense, you can literally just buy these 6 stocks yourself. The yield on their fact sheet shows 4.24%, but this was created a few weeks ago and the stock has increased since then, so obviously the yield has gone down. If you need the cash from the dividends, that's fine. Do with it what you want, but if you really want to see your returns grow over time, enroll in the dividend reinvestment plan so your dividends can earn more dividends in the future. My second recommendation is you invest $200 or 20% in VRE.to. This is Vanguard's real estate fund. It is currently trading at $30.60 and pays a monthly dividend of 3.6%. That's the yield. Similar to the previous ETF, this is all one sector and all in Canada. It's really only real estate. There are 16 stocks in this fund with a mixture of different sectors, with residential and retail taking up the biggest chunk. The management expense ratio is at a reasonable 0.39%. Again, I'm not sure why zeb.to was so high. It has less underlying stocks and they're both monthly dividends. Anyway, it's still a good ETF regardless. I chose this ETF for the stable monthly dividend and because I'm bullish on Canadian real estate. I might be biased because I'm working in the commercial real estate sector, but if I worked in real estate and I told you not to invest in real estate, isn't that pretty telling? The real estate sector has taken a beating and has yet to recover in comparison to other stocks and industries that have already caught up to their pre-pandemic prices. That doesn't mean that you shouldn't buy this because it's down. I just think it's a great buying opportunity because there's a chance for capital appreciation as well. Before the pandemic tanked all the ETFs' underlying holdings, the annual price appreciation was 9.4%, not including dividends. Obviously, it's a little lower now. It's sitting at 6%, not including dividends. I do think this will be a great ETF for beginners to have in their portfolio, especially if you only have $1,000. They'll get some nice capital appreciation as well as some dividends. Third on the list, I'm recommending you invest $200 or 20% in xut.to. This is the iShares utility fund currently trading at $29 and paying a monthly dividend with a yield of 3.11%. It currently holds 16 companies in the fund and rebalances quarterly. The dividends are paid monthly, and you do have the option of a dividend reinvestment plan if you don't need the monthly cash from the dividends. Utilities are more of a defensive play. In bull markets, when all the other growth stocks are shooting up, utilities won't do as well. But on the flip side, when the market tanks, take a look at Enbridge, Fortis, and Emera. All the stocks that I own, they've been killing it. They pay a high but stable dividend. Some even increase the payout every year. Taking a look at the performance, the ETF has returned 113% in 9 years, or 12.5% per year, including dividends. I chose this ETF so you have a more conservative / risk-averse ETF in your portfolio. I own many of these stocks myself, so it doesn't make sense in paying the 0.55 or 0.6% management expense ratio. I own all the top 5 holdings of the ETF already. Last on the list, I know this gets repetitive. You've heard me recommend this ETF a number of times, but it's obviously there for a reason. I'm recommending you invest $400 or 40% in VSP.to. This is an ETF that tracks the S&P 500, the largest 500 companies in the US. You're actually not investing in this one for the dividend, although they do have a small yield. You're investing in VSP for the capital appreciation, and any cash you get on the side is a little bonus. This ETF is hedged to the Canadian dollar, so whether or not the US goes up or goes down, this has underlying hedges which offset that balance. So you're only at risk of the underlying stocks, you're not at risk of currency as well. I do feel the S&P 500 should be the largest part of your portfolio. If not, then maybe a global total market fund like VEQT, which invests in the whole world pretty much. Everyone refers to the S&P 500 as the market. If you can't beat the market, if you can't get these 9.8% annual returns, then you're just wasting your time. You should just invest in the S&P 500. With this ETF, you'll be indirectly owning Apple, Google, Netflix, Facebook, Nvidia, Amazon. What else am I missing? Maybe even Tesla, depending on when this video comes out. I can't end a recommendation of the S&P 500 without recommending the non-Canadian hedged ETF, which is VFV.to. Pretty much the same as VSP, but you're at risk of currency as well. So let's say the S&P 500 goes up and the currency goes down, then it kind of offsets your gains. But on the flip side, you can get a double gain if the currency and stocks go up, and you can get a double loss if the currency and the stocks go down. So depending on what type of risk you like, you have those two options. That's it for this video. Thanks for all the support. I might wait a few weeks to see how this video does, to see if there's appetite for a $5,000 or $10,000 beginner portfolio recommendation. I've been getting a lot of recommendations on mushroom stocks, and I should break them down and which one would I choose. To be honest, before last week or 2 weeks ago, I didn't even know mushroom stocks existed, so I'll need to do my research. I might even release some recommendations on what mushroom stocks, and if I would invest in any of those. So until then, thanks guys.